Hello, everyone, and welcome to this episode of Interactive Brokers Podcast, IBKR. I'm joined today with Rob Anderson of Ned Davis Research. How are you doing today, Rob?
I'm good. Thanks for having me.
Absolutely. It's a pleasure. Ladies and gentlemen, Rob Anderson is a U.S. sector strategist at Ned Davis Research. He's a member of the firm's strategy team, focusing primarily on U.S. equity sectors. His research is used for publications covering Ned Davis Research's sector strategy and U.S. strategy products. Rob earned his Bachelor of Science degree in Banking and Finance from the University of Missouri and received a Master of Business Administration MBA degree from Webster University in St. Louis, Missouri. Rob is a CFA charter holder and is a member of the CFA Institute, and we are happy to welcome Rob and talk about U.S. sectors and all things markets today.
Yeah, I'm happy to be here. Thanks for the invite. Excited for the conversation.
Terrific, terrific. So, Rob, coming off of the election, we have a red sweep. Former President Trump back in the Oval Office, majority for the GOP in the Senate, slimmer majority in the House. How does that backdrop help or hurt U.S. equities?
Yeah, I think the initial reaction that we've seen is pretty similar to what we saw in 2016, as far as stocks performing pretty well. And from a leadership perspective, too, was looked pretty similar, where we had a lot of cyclical sector leaderships and defensive sectors have been lagging. Sectors like financials and energy have performed really well with the hopes that we'll get some deregulation from Trump. And I think that makes a lot of sense. And those are also sectors that could benefit from faster economic growth as well from some of Trump's policies. I think you got to ask yourself the question now, how long does this initial Trump trade last? And looking back against 2016, really the energy and financials trades faded pretty early. They lasted through, about mid-December, and then both of those sectors started falling off and underperforming. So I think that's a good kind of warning where, the market's going to probably start focusing on other things other than the election over the near term. And that's something to keep in mind. But I do think going into next year, Trump policy is going to be an important driver for the market, especially where that policy is focused first. Back in 2017, taxes was the focus initially. This year, taxes will probably be focused, but also trade. Tariffs are going to probably come into effect pretty quick. And tariffs didn't really get going during his first term until about 2018, 2019. So I think that's a difference, and that's a risk for the markets where, next year could potentially be volatile because of that.
That's interesting. So I've been writing a lot of my pieces. We can have more upside in equities, but not without Trump bumps along the way.
Yeah, I like that.
Yeah, not just Trump, but also a lot of his cabinet members have a tendency to express how they feel when they feel like it, right? They're more transparent. In Trump 1.0, we saw the president talk about really interesting things that drove volatility while the market was open, right? Geopolitics as well. So I totally agree with you in terms of some bumpiness next year. And usually in the third year of a bull market, we do tend to see some kind of volatility, especially like with the valuations where they are. And another source of volatility, I think, Rob, can come from inflation rates and the Fed, particularly against the backdrop of those tariffs and potential impacts of immigration, also fiscal deficits, fiscal stimulus, what's going to happen with the IRS, all of the above. There's just so many different things to talk about. How are you thinking about the Fed rates and inflation?
Yeah, starting with interest rates, we've seen a pretty big move in the 10-year. I think mid-September we're about 3.6. Now we're approaching 4.5%. That's a pretty big move. But one of the things that we track in NDR is how fast the change in interest rates are happening. The market can absorb higher rates if it happens gradually. When you get moves like this, where you see a big jump that happens over a pretty short period of time, that's when the market can run into some issues. And again, given the backdrop of higher valuations, like you mentioned, I think that's a risk for next year. But, I think bigger picture, inflation expectations haven't really broken out to the upside. I think if that happened, that would be a pretty big risk, and a risk for longer term interest rates as well. The framework that we kind of use at NDR, as far as the Fed goes, and as far as equities go, is how fast is the Fed moving? It might seem on the face that if the Fed is cutting rates rapidly, that should be a good backdrop for stocks. But what we have found is that the stocks tend to perform better when the Fed is moving at a more measured pace. They're cutting rates slowly. Stocks have tended to do better when that's the case. Leadership has tended to be a little bit more cyclical when that's the case. And the reason for that is when the Fed is cutting fast, it's usually in response to something. There's a crisis. There's the economy's weak. There's issues in the banking sector, whatever. So they're responding. A lot of times they're responding too late. The economy falls into a recession. Stocks don't do very good. But when the Fed is able to cut slowly, they're doing that because the economy is resilient. And that's our base case for next year. Our macro team expects a rate cut in December and then 3 more cuts next year. So that's a pretty slow, deliberate pace from the Fed. And I think ultimately that should be a pretty good backdrop for stocks next year.
Yeah, I totally agree. What you saw during COVID when the Fed cut immediately down to zero, and that was a crisis kind of situation. We've also seen that back in prior to the great financial crisis. Yeah, I've been writing also about a slow walk down the monetary policy stairs rather than a sprint down. In fact, this morning, it is November 22nd, ladies and gentlemen, we got the flash PMIs from the US and the EU, and the euro is doing really poorly in the last 6 to 8 weeks or so against the dollar. And part of that is there's expectations that those economies are going to perform poorly against the backdrop of those tariffs, especially since they're really export oriented. That backdrop, however, with tech here in the US, turning back to stateside activity, here in the US, technology has really been a huge driver of the gains, not just in 24, but also in 23. The Magnificent Seven stocks, we all know well their names. But you mentioned cyclical leadership, especially on the walk down from the Fed.
Yeah.
How are you thinking about positioning into next year?
Currently, we are bullish on stocks. We've been bullish all year. On a relative basis, we favor stocks over bond and cash, so we're overweight, max overweight stocks right now. What I do at NDR is I'm responsible for the positioning within US equity. We have a framework where we have a call on all 11 GIC sectors for the S&P 500. And currently we're overweight energy, financials, and consumer discretionary, and underweight healthcare and materials. And that positioning is in line with our models. So all the calls at NDR are backed by quantitative models. And our sector model has shifted pretty decisively cyclical over the last few weeks. So the positioning is in line with the model. And it's also in line with post-election tendencies, where post-election, you do tend to get a relief rally when some of that uncertainty that clouded the market pre-election is lifted. And leadership does tend to be more cyclical post-election. And that cyclical leadership tends to carry into the post-election year as well. Really strong cyclical leadership first half of the post-election year. That's how we're positioned and some of the reasoning behind that as well.
Turning back to the Magnificent Seven and valuations, how does valuation fit into that framework? And by the way, the calls have been pretty on the money when you look at the Russell coming in on an all-time high. Last it saw these prices was back in 2021. The Dow Jones, also cyclically oriented index, has also been performing really well, better than the S&P and the NASDAQ and the Qs in the last few weeks or so. But how are you thinking about mega caps and valuations and how that sort of fits into that framework?
Yeah. Valuations aren't cheap, obviously. It's like looking at the PE ratio, for example, for the S&P 500 on a trailing basis, you're at about 29 versus an average of 23. And you can try to rationalize to yourself, okay, some of this is skewed by the mega caps. But even when you look at the median PE ratio, you're at 27. And going back to 1960, you were higher in 99, you were higher in 2021, but that was it, right? It's hard to rationalize that we're cheap at these prices. You can't really do it. But I think the question is, okay, we're expensive. What do you do with that information, right? We're expensive coming into this year and stocks are up 25%. So obviously, everybody knows valuations aren't a great timing tool. I think what you can do with that information is shift your expectations on what kind of returns you should expect going forward. Probably not going to get 20% next year again. But at the same time, at NDR, we use what we call a 360-degree approach. Fundamentals is one of the pillars. So valuations, earning growth, all that's really important. But we also look at things like sentiment, technicals, and macro. And I think we talked about the macro backdrop. I think it's pretty favorable for stocks going into next year. You look at the technical picture again, I think technicals are still pretty bullish for stocks. You're not at the point now where you want to get out of U.S. stocks just yet, I don't think. Valuations, I think, given where they are, something you want to keep in the back of your head that when things go south, you probably want to consider taking risk off the table. But right now, I don't think we're there yet.
So what do you mean we can't get another 20% year? That's all we're used to these days.
I'm not saying we can't. I'm just saying, given where we are, I wouldn't bank on it. But it's at the same time, the Meg 7, I wouldn't bet against them either. They're expensive, but NVIDIA reported earlier this week, so all Meg 7 components have reported, and they've all beat on bottom line estimates. Some of the responses from the market weren't great, but most of them are up since reporting. I think the risk there is the risk for the overall market as well going into next year is that earnings are expected to decelerate pretty rapidly for the Meg 7. I think Tesla's an exception where they're expected to actually see earnings accelerate, but everything else is going to see pretty significant deceleration. And that might be an underappreciated risk, I think, given the run they've had and the massive amount of CapEx that these companies have spent. Something that we looked at is what factors perform well in equity downturns, and what doesn't perform well is high CapEx to sales ratios. And all these companies have seen, just massive increases in CapEx. I think that's a risk, even going back to 2022, that bear market was tech led. And if you remember back then, it was Meta, which was investing a ton of money in the metaverse, and their stock got absolutely killed during the 2022 bear market, where it was down close to 60%, a little over 60%, I think, during that bear market. And all Meg 7 stocks other than Apple underperformed in 2022. I think the combination of high valuation with a high level of CapEx and R&D spending, I think that's could be a risk going forward when we do eventually get the next downturn. But again, we're not there yet, so I don't think you want to bail on these guys yet either.
So what do you think is a reasonable return to expect, let's say, in the next 5 years? And the reason I asked that question is because we have these rates that are quite high based on what we're used to in the last post great financial crisis kind of mindset. So some folks look at the 2-year here at 437, the 10-year at 441. If we're only expecting equity gains, say, of 8%, then if I'm parked in the 2-year, I'm getting more than half of that without taking much of a risk, or theoretically no risk at all. What kind of returns do you think we should expect maybe next year and the next 5 years?
We haven't given our 2025 outlook, so our chief equity strategist is responsible for our call there. But I think I would expect 5 to 10% will probably be where he falls in for the gains expected in 2025. I think looking out next 3-5 years, we're still in a secular bull market. This started after the GFC, and we're going into the 15th year now. The average secular bull lasts about 14 years. Now, there's some variance in there, but still, we're probably in the later innings of the secular bull market. I think that it probably continues for a while longer. Maybe for the next 3, 4, 5 years, we remain in that secular bull market and we can still earn above average returns. I think somewhere in the neighborhood of 10 to 15%. I don't want to throw numbers really out there because it's guesswork, but as long as we're in the secular bull market, I think you can expect pretty healthy returns. But again, given where valuations are, given where earnings growth is, given economic growth, I think it all kind of points to the fact, given the duration of this bull market, it all kind of points to the fact that we are in the later stages. And to your point about the interest rates, there's options now, right? There were no alternatives for a very long time. Now we have alternatives. I think given that backdrop, that the bull market is probably on a borrowed time at this point. But again, all this is scary when you talk about it. You don't want to bail too early either, because that's a massive risk, right? We talked about it. If you were scared off of valuations earlier in the year, you're probably kicking yourself right now. It's important. I think it's a really important conversation to have, and it's really important to keep in the back of your mind. But I just, like I said, I think it's probably too early to bail on stocks just yet.
Since 2022, Rob, a lot of us in the economist camp were calling for recessions. We thought that the economic data was souring in certain months or in quarters, Rob, and then the economic activity would recover the same way the investors buy the dip in the S&P 500 and you just see it go back. In fact, with retail sales, we've seen that so many times this year and last year where it seemed like consumers just really took it easy, didn't shop, were looking to replenish their savings. And some folks thought, oh, wow, this is a downturn. The consumer is over. Remember that Fed research from San Francisco in 2023 about excess savings and all that. So it's really been a remarkable consumer spending expansion, in my view, driven by fiscal stimulus, tight labor market, and the stock market, which has just been terrific above right now, up 26% year to date. Last year, I think it was right around 25, 24. Just
Yeah.
amazing returns. Talking about alternatives, something I notice in other parts of the world, Europe, Japan, those economies aren't doing that great. But the stocks there are also doing phenomenal. They're rallying. How do you feel about international allocations across regions? Do you think it's maybe justifiable or warranted to have a portion in Europe, Japan, China? China, actually, their economy's been performing poorly, but their markets have also been bad. So I guess a lot to unpack there. Generally speaking, what do you think about international stocks?
So our global team has a set away framework that we use for the regional equity allocation. And those regions include the US, Europe ex UK, emerging markets, Pacific ex Japan, UK, Japan, and Canada. And right now we are overweight the US, right? Despite the valuations, there's a lot like in the US. And the other region that we're overweight is Pacific ex Japan. And from a valuation perspective, a lot of these regions are not cheap either. I don't think Pacific ex Japan is particularly cheap, although I think there are countries within that region that are cheap. The biggest country there is Australia. And I looked at Australia's valuation. They don't, seem like particularly cheap. Hong Kong is the second biggest country in that region, and valuations there are a little more attractive, similar to China. It's not just the fundamentals, it's the sentiment, it's the macro, it's the technicals. And that's the reason why our global team likes that region, is all that is working in favor of those countries right now.
All right, ladies and gentlemen, that's Rob Anderson of Ned Davis Research. Thanks so much for joining, Rob.
Thank you. Appreciate it, Jose.
Folks, I'll see you next time on our next episode of Interactive Brokers IBKR Podcast. Don't forget to hit subscribe and access our podcast. Until next time, thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.